Let's try this again. Hello and welcome back, everyone. It's a pleasure to be here with you all on Veterans Day to talk a little bit more about the stock market. Today the past 2 days have been extremely exciting in the market as we've seen recoveries across all sectors as well as some very substantial gains that are, in terms of the past 10 years, among the top 10. So I want to talk about and put this past week into context. I want to look at what's happened from quarter three earnings, what actually led to the massive price increases that we saw on November 10th, as well as talk about my thoughts and concerns and feelings around the big question that everyone's probably thinking: when is this bear market going to end? Are we seeing the end of it right now? Is this the beginning of a bull market? Or are we getting a little ahead of ourselves? To help defend my ideas and my stance, we'll talk about all of this in a little bit more comprehensive terms today in the webinar, as we'll review quarter three earnings, what actually happened this week to cause the massive price increase, and lots more. So, I'm going to stop talking directly to the camera and start talking towards the presentation as we get into today's topic, covering quarter three 2022 earnings, the market, and yes, the big question: is the bear market over? Disclaimer. Today, this disclaimer actually matters. What I'm going to be sharing today is my opinion. I've done my own research. I've come to my own conclusions based on the data and research that I've found, and it is very much my personal opinion. This is not me saying this is what's going to happen. This is not a promise. This is my thoughts and opinions of the data. I will share with you all the sources of my data so that you can look at it all as well and come to your own conclusions. I very much encourage you to come to your own conclusions. And if you don't agree with me, or if you do agree with me and have something to add, put it in the chat, put it in the comments. It's great to have a conversation, and everyone's opinion matters. My opinion is just one voice among many, so share your opinion as well. The goal for today's webinar is large, but pretty straightforward. Last week in our November market forecast, we talked about the very strange behavior that's been happening with the stock market surrounding quarter three earnings. Today, we can talk about it a little bit more comprehensively, because as opposed to last week when we talked, all we had was 50% of the S&P 500. Today, we have 91% of S&P 500 earnings. So this is enough for us to be able to look at it and kind of figure out how the market has responded to earnings. Most importantly, the vast majority of these earnings came when there was a little bit more uncertainty in the market. I very much foresee the remainder of earnings acting much differently than how we've seen the first 90% of earnings before we got this big news that caused the market to jump 5% in a single day. But in addition to reviewing earnings, I also want to talk about the current trend in the market. We have been in this bear market now for going on 11 months, and since the peak. So it's valuable for us to be able to look at where we are right now in relation to not only then, but also the previous attempt that we had to get out of this bear market back in August. So we will review what this current trend is, the sectors who are leading but also dragging it back, and some of the reasons behind why this trend might be happening, as well as the big question on people's minds: is the bear market over? First things first, before we even get into earnings, we need to talk about why earnings actually matter. And if you're just watching this webinar for the first time, you're like, what are earnings? Quick explanation. Every 3 months or every quarter, we get financial reports from publicly traded companies. They are legally obligated, not contractually, they are legally obligated to provide us with multiple reports every single year detailing their financial statements. These reports offer investors a way to see not only their profitability and where they're making or spending money, but also the revenue that they generate as a result of their ongoing behavior. Now, two of the most important parts of these earnings reports, Again, the actual reports are pages long. There's statements from the executives. There are profit and loss statements. There's balance sheets. If you're an accountant, you'll get a lot more interest out of those financial reports than an investor or I would. The part that investors usually focus on are two things: earnings and revenue. These results are published after the quarter ends, obviously, but they're published pretty far away. So quarter three ended at the end of September. We didn't start to get earnings until October 15th for the majority of companies. So in that time, and even before then really, many analysts and other professionals spend their time and resources trying to figure out what they think a company's earnings will be. They try and estimate earnings based on a number of factors such as actual sales, polling data, and a number of other factors to try and get them as close to the accurate number as they can to answer the question, how much money are they making, and what is their overall profitability looking like? So earnings are incredibly important because it tells us a lot about a company. Company value is usually, a stock's company value is usually made up of two main parts: present value and future value. What is it worth today? What do we think it's going to be worth tomorrow? Company earnings are the best indicator that we can have of that present value. It is talking about not what could happen, but what has happened. So when we look at trying to figure out a stock's fair price, the results of their earnings are very telling and will influence that current value price significantly. For some companies, that ends up being a lot more than the future value part. There are companies that have been around for decades and will be around for decades longer. You don't buy them because you think that they are going to grow 50x in the next 3 years. You buy them because they've been around for 50 years. They've been paying dividends for 50 years maybe, and they'll probably be around and paying dividends for another 50 years. You're paying for that company. You're paying for what they're worth today. They're a great value today, as opposed to something else that might be worth something more or less in the future. Think of the Teslas and back when Facebook was still Facebook, the Facebooks of the world. The companies that they are growing quickly and that we don't know where they're going to be next year. We hope that they're going to be growing bigger and bigger and bigger. Reality sometimes will end up a little bit different than our fairy tales might want us to think. But either way, the future value, we never are certain. The thing we are certain of, though, is what's happened now. And what their earnings are is our best indication of that. So that's the reason why earnings are such an important point and time for the market. It is the reality check to all investors and companies alike as to what's actually happening monetarily for them. Now, how much a stock's price actually changes as a result of its earnings can vary pretty wildly. We saw some companies that saw losses of 8 to 9%, but missed analyst estimates by tens of thousands of percent. You think I'm kidding? I'm really not. There was one company in particular that missed earnings estimates by, I think it was 18,000%. Let me see if I can find it. Boeing. This was their estimates. Sorry, I overestimated. They missed earnings estimates by 9,372%. As a result, their stock price did drop. Oh, come on. There we go. It did drop about 9% in a single day. But there are other companies that didn't miss estimates that much that saw double-digit losses. And most of those double-digit losses have stuck. They are still in that hole. So just because a company misses estimates doesn't mean that its price is just going to tank proportional to how much it missed estimates by. What really happens can vary pretty wildly. So the best thing we can do is find averages. Try and figure out what the average earnings estimate, their average revenue, and also how much the stock's price has responded to those estimates, whether it beat estimates and rose, missed estimates and fell. All of that is valuable for us. And we can compare what's happened this quarter to past years. And in the case of our data we're looking at today, 5-year averages to see if the market is rewarding companies more or less based on their changes compared to analyst estimates. Before I get too far into it, I do want to provide the source for all of the data that I'll be talking about for earnings. If you've been around Sectors Made Simple for a bit, you should be familiar with this website, FactSet. They publish a ton of really, really great financial data. Whenever I talk about earnings, this is usually where I go to find the majority of the data that I present and I try and base my conclusions on. It's comprehensive, it's non-biased, it is great data. So if you're interested in figuring out a little bit more and don't want to just get it from me, check out the FactSet article in the live chat, or it'll also be in the resources section of this video if you're watching it recorded. Very interesting read. If you're not interested, or if reading data just makes your eyes glaze over and it's more of a bedtime story than it is a pastime for you, that's why I'm here. Let's talk about what actually happened. But before we do, let's set the story here, all right? Earnings season is a fairly loose term. It typically will come about 4 weeks or so after the end of a quarter. 2 weeks or so after the end of a quarter, and will go about 4 to 6 weeks after that. So in the case of quarter 3 earnings, we are looking at a range of October 15th to November 11th. It's not that there was nothing before October 15th and nothing after November 11th, but the big chunk of it will fall between those dates, with the majority of that happening between October 22nd and November 11th. Now, prior to earnings, before quarter 3 2022 earnings, we saw the market hit some pretty low lows. After we saw a slight recovery back in August, we did see the S&P 500 drop once again, reaching a new low in the beginning or middle of October. Since the beginning of 2022, that low ended up being over 25% down from its January high. Now, like I mentioned before, this was not a straight ride down to the bottom. We actually did see a moderate recovery back in August. And I did a similar webinar to this then and tried to talk about some of the reasons why we were seeing that. And one of the main reasons that we were seeing recovery in August was that we thought things were getting better. We thought that the Fed is being aggressive with trying to make changes to the federal funds rate to tackle inflation. Company earnings weren't as bad as we were expecting them to be. And in fact, for earnings for quarter 2, companies that didn't meet estimates, companies that missed analyst estimates, didn't really get punished, having, I think it was a negative 0.1% loss on average. On the other end, we saw companies that beat estimates being rewarded heavily, with those averages well above the 5-year average for what we should expect to see for positive surprises. Now, after that, more economic data came out, inflation was still going up, things weren't getting better, and market confidence dropped once again. That led to September. Then in September, we got new data showing that inflation was still pretty hot. Things dropped a little bit more. October's data saw a little drop in inflation, but nothing close to what we had wanted it to be. Market dropped even further. So that's where we were leading up to quarter 3. Due to worsening economic climate, those aggressive changes to the federal funds rate, and really a lot of this is circling around the big R word that no one wants to talk about here, recession. As people started to get worried about that recession, are we in a recession? Are we entering a recession? How do we avoid a recession? We saw the market continue to sink because we were getting no good news and everything that was coming out was either neutral or bad news. That left us in a very precarious place going into quarter three earnings. We wanted something. We needed something. And it didn't need to be good news, it just couldn't be more bad news. Well, did we get that? Were quarter three earnings good news, not bad news, or bad news? Well, did we get more confidence from October and from our quarter three earnings? Yes and no, kind of, not really. I covered this topic a little bit in last week's webinar. Both in the members webinar on Tuesday, I covered it in a lot more detail. We talked about that FactSet study and the first half of the S&P data we had. Then in the Friday webinar, we focused a little bit on the background of all of this, but also tried to look forward at November and say, all right, what's going to happen in November? What should we keep our eyes on in November? But now we have a little bit more of a complete picture of earnings. Is it all of it? No. 91% is what we have. But I wanted to have this conversation today because, again, yesterday was a huge day in the market, and I really wanted to talk about that, but you couldn't just talk about the whipped cream instead of talking about what's sitting under the whipped cream. Because it is not ice cream, it is a little bit more of a rocky road. So let's now talk about the whipped cream, the rocky road, and how we got here. Let's start off with the part that we don't want to think about. The bad news. What were the negatives that came from quarter three 2022 earnings? The first and probably biggest one is the fact that earnings growth was sitting at 2.2%. That is not good. That is 25% of the 10-year average at 8.8%, with the 5-year average still over 3 times higher than what we saw in quarter three 2022 earnings. Now, as much as I hate to say it, that 2.2% number, that's the good news. The bad news is that this was heavily due to a single sector, energy. Energy has been the subject of conversation for many of our webinars in 2022. It is the only sector in 2022 that has been seeing positive returns, and it is by far our sector leader at the moment, but not for the reasons we might want it to be. Energy is a huge pain point for many consumers as it continues to be the largest impact on our inflation. Food and energy are two of the largest components of our very, very high levels of inflation right now. So seeing earnings growth in energy is kind of a bitter pill to swallow. Yes, it's great that some area of the market's doing well, but at the same time, the companies are doing well. The people that use those companies and use gas and oil, not so much. But we're here to talk about the investing side, some of the economic side, and I leave the consumer side to others. If we exclude the energy sector from that 2.2% average, that 2.2% drops 7.5% down to a loss of earnings of 5.3%. Again, the average for the 10 years is a growth of 8.8%. It is a quarter of that if we include energy. The minute we cut energy out, it drops to negative 5.3%. Now, the communications sector was easily the hardest hit. Communications got destroyed by earnings, with an average earnings loss of 23%, with a heavy proportion of that coming from Google, Meta, and Warner Brothers Discovery. Those first two we talked a decent bit about in both the members webinar on Tuesday from last week and Friday's November market forecast. Warner Brothers is the new addition to that group, falling into the same lump of they aren't growing and their earnings were very poor, resulting in a massive drop in stock price. Israel is saying the CPI report last Wednesday gave us some green light. Don't skip forward to the last page. That is the cherry on top that we get to talk about later. That is the sweet part of this story. Again, I'm starting with the ice cream here, and we're talking Rocky Road. So there was a lot of negatives. There was more negatives than positives with earnings. That's why we didn't really see a boom from earnings that we'd kind of seen back in quarter two. It's not to say that there weren't positives and there weren't gains, but they were heavily offset by losses. Compared to quarter two, where we saw many companies not be punished for poor earnings. While we did, I'm going to get ahead of myself if I just keep talking. Let me go through the slides and then I'll ramble. On the good side of things, on the ice cream side of our rocky road, quarter three earnings beat analyst estimates, leading to a pretty large change compared to the 5-year average. Quarter three earnings that beat estimates resulted from the 2 days before to the 2 days after their earnings reports, an average of 2.4% gain compared to the 5-year average of 0.9%. While it is not highlighted here, I do want to mention, because I was about to say it before, it's not like quarter two earnings, where we saw companies that beat earnings be rewarded and companies that didn't beat earnings let loose with a warning. We saw companies that outperformed earnings get rewarded, but companies that didn't outperform estimates getting hammered. That 2.4% is not only the good side. On the other side, companies that didn't meet estimates got hit harder than average, over 100% more than their historical compared to their 5-year average. Let me see if I can find the chart really quickly that illustrates that. Again, the study is all in the comments, and again, I'll put it in the description as well. So what we had was, for the positive side of things, we had 2.4% compared to the average of 0.9, and it's not 100%, it's 50%. The negative side of things, from the average of 2.2% loss for companies that missed estimates, we saw a loss of 3.5% from this past quarter. So companies were being rewarded and punished more in this earnings season. Now, looking past earnings and towards revenue, what we end up finding is that quarter three is actually above the average for revenue growth, with 71% of companies beating revenue estimates. That is a good sign if you're a business. Now, the revenue growth rate is an interesting one, because in terms of are we moving forward or are we seeing pullback, this revenue growth rate has consistently been at 10 or higher percent for the past seven quarters. So we are seeing a continuation of that. Is that in itself a good thing? Well, it's not a good thing, but it's also not a bad thing. It's just, okay, we're continuing on the same trend. Again, right now, good news is great. No news is good, and bad news is bad. So revenue growth is that kind of, it's not good news, it's not bad news, which means it's good news. Now, the biggest thing, once again, for all of earnings, energy. Energy continues its dominance overall. It's leading in earnings estimates. It's leading in the average surprise. So when it beats estimates, how much does it beat them by? It's leading in that. It's leading in earnings growth, and it's leading in revenue growth, being second for a number of other earnings-based estimates. So energy is dominating the market. It's dominating earnings. It's dominating revenue. And if we exclude energy, things are looking not so great. A lot of that loss and a lot of that negativity is based in the more sensitive sectors, such as technology, communications. So, did earnings actually help the market? Kinda did. Again, earnings did positively impact many companies, and more so than it did in previous years. But again, many of these positives are highly skewed because of energy's absolute dominance in terms of sector relative strength, as well as earnings and their magnitude of returns for those earnings. We did see that earnings caused the collapse of a number of different stocks' prices, such as Meta, Warner Brothers, Apple, and Google, which all saw losses of 10% or more in the 2 days following their earnings calls. But with the exception of Meta, the majority of these companies have made some solid recoveries, recouping most, or in some cases all, of their losses that they sustained as a result of their earnings. Does this make sense? Does it make sense that a company's value can drop so much? And Amazon, yeah, this is true. Does it make sense that a large company can have its value drop so much as a result of earnings, but then recover it pretty quickly? Well, it depends on if the market was reacting or if it was something in the earnings that genuinely shifted its value. In the case of Warner Brothers, Apple, Google, and all of them, a lot of it's coming down to just stagnating revenue. It's not that they are losing billions of dollars, it's that they're not growing at the same rate that they were previously. For Meta, things get a little bit trickier. They have most of their stock value loss is not because of just a momentary shift or some sort of change in expectations. It's been a constant trend downward. They've been investing heavily into this whole idea of the metaverse. I'm not going to get into all of that. We do already have a webinar on VR, AR, and the metaverse. I talk about it there. I talk about my opinions of the metaverse there. But Zuckerberg does not care about my opinion of the metaverse. He's going to do it regardless. And they're spending billions of dollars towards doing that. So when that's the case, that is them investing heavily into something that the market does not see return for. That is the reason that those losses are sticking a little bit more than others. Israel saying Tesla hit their lows, their lowest ever, I think. Yeah, that's a whole story that I don't want to get into today. Tesla's stock price is tanking. Musk is making some very interesting decisions with Twitter. I'm kind of just watching all that from a distance, glad that I'm not in the middle of it. Let's talk earnings here. And let's kind of end earnings here. Here's the biggest thing that I took away from earnings. Again, I'm summarizing pages of analysis and data by fact set into a single thing. I very much encourage you to go and read that data yourself and create your own conclusions. Here's mine. We thought things would be bad, and they weren't as bad as we thought. That's where a lot of it comes down to. The market, again, did not need good news. It just didn't need bad news. Couldn't have bad news. So what earnings actually showed was, yes, there is weakness in a number of major companies and a number of different sectors. Just to highlight one area, one specific area, advertising. Advertising revenue is down for a number of large companies. If we look at three major players in the digital advertising space, Meta, Google, and now Amazon. For the past couple of years, Amazon has been gaining ground. They've been taking market share away from Google and Meta. But until this quarter, Google and Meta's advertising revenue was still growing. Meta and Google in quarter 3 posted losses for not losses like they lost money, but their growth, their advertising revenue growth stagnated and actually regressed a little bit. So they lost year over year growth in advertising revenue. While Amazon actually saw an increase where their ad revenue went up 58% compared to the same point last year. This firmly cements Amazon as the third largest online ad seller and again, a continuing player in this digital ad space, gaining market share, but also gaining overall value, while other competitors such as Google and Meta are falling backwards. This is a single industry that I am highlighting right now, or a single revenue stream. For Google and Meta, advertising is a much larger part of their overall revenue stream. For Amazon, it's still single digits. Less than 10% of Amazon's revenue is generated through advertising. So this is not the company is made or broken from advertising like Meta and Google are. They are much more reliant on advertising revenue to generate that value, both present but also future value that we give to these companies. For Amazon, their revenue is much more diversified. They have Prime Video, they've got streaming services, they've got distribution. They are a very broad company. Ad revenue is a very, very small part of that. But again, they're now still the third largest ad player in the digital space. But looking beyond ads, we actually have seen a number of different industries see growth, despite what the overall earnings might make us think. There were a number of different industries, such as airline and travel, that took very large hits in 2020 as the result of lockdowns and people cutting back on travel, that have begun to recover pretty nicely. So airlines, travel, and other leisure-based industries have been doing fairly well, despite what those Boeing earnings might say. Bringing all this now into overall market trends, putting this back into context of the market and not company performance. Quarter 3 earnings are almost done. Again, for the S&P 500, we have 91%. But in terms of the overall market, we are finding ourselves once again in a market that is showing positive signs of recovery. Quarter 3 earnings didn't bring bad news. It didn't bring all that great news, but it showed us that things might not be as bad as we might have been expecting them to be. Now, profitability and earnings, again, those are very company-based problems. Now, something that is really affecting not just companies, but investors, but more broadly, consumers, is inflation. Again, the major turning point in various months over the past couple of months, so since about August through October, the CPI data, just about every time that data has been released, the market has responded poorly to it, because that is what the market is worried about. The market is not as concerned about earnings. They care about earnings. That's why we're seeing 2 consecutive quarters where companies that beat earnings estimates are rewarded heavily for it. But it's not as important as the big thing that investors, consumers, and companies alike are worried about: inflation. Now we start to get into my opinion side of all of this. In my opinion, in order for us to actually see recovery, and I'm not just saying like a good day or two, we're actually going to have to see some changes to inflation. I don't think any gains can really stick until we see inflation start to tick down. This is the thing that consumers are worried about. It is the thing that consumers are feeling the pressure of. And I think most people aren't as concerned about the idea of a recession as much as they are worried about the idea of inflation and what that means for them. Now, let's take a look at what happened last week. Last week we had the FOMC meeting on November 1st and 2nd. From this meeting, the Fed came out announcing a 0.75% increase to the federal funds rate. And in addition, Chairman Jerome Powell gave a very hawkish, very pessimistic speech, or cautious speech, I should say. They will continue putting pressure on until inflation begins to tick down. Their goal is still a soft landing where we don't truly drop into a recession, more of a glide down. But as time goes on and inflation remains high, the chances of that grow slimmer and slimmer. And some of his messaging seems to indicate that as well. But last week, again, the market responded poorly to this speech. We saw an immediate decline in stock prices across the market. And while there were some recoveries, and I'll call them adjustments, over the next few days, we wouldn't really get any good news until November 10th. November 10th, yesterday, if you're watching this live, is where things actually took a turn for the better, and is where all of this kind of question of today's webinar, is the bear market over, really stems from. Because if you notice so far, it's kind of weird talking about is the bear market over as we're talking about the market dropping as a result of the FOMC, under average earnings, and not really much good news to be found. Yesterday makes up for that. Yesterday, November 10th, 2022, prior to market open, the BLS, or Bureau of Labor Statistics, released the Consumer Price Index, CPI inflation numbers, for October 2022. If that's a bunch of big, crazy words, I don't blame you. Basically, here's what it means. What are urban consumers spending on stuff? What does it cost us to buy stuff? What does it cost us to put fuel in our car? What does it cost us to go to work? What does it cost us to buy food? What does it cost us to keep power on in our house and heat, or AC? There are 2 types of CPI inflation. Headline CPI. That is the number that most news sites are going to use. Quite literally, it's called the headline inflation number. The core inflation is the same thing as the headline CPI, but it excludes food and energy from those numbers. These are 2 industries that are very, very, very volatile. Food prices and energy prices can vary wildly, and because of that, it's valuable for us to know inflation with and without those two values. Let's start off with headline CPI. It's the one you're probably going to see. It's the one you're probably going to hear about. So it's the one we're going to cover first. In this release, the Bureau of Labor Statistics, BLS, noted a 0.5% decrease in headline CPI inflation from 8.2% to 7.7%. That is big. Part of the market's pessimistic response to the previous CPI inflation announcement last month was the fact that despite the Fed's aggressive approach to tackling inflation, we saw a 0.1% decrease. This month, we expected something a little more conservative. And actually, if we look month over month, the estimate was 0.3%. Sorry, 0.5%. And we saw an increase month over month of 0.4%. That might seem like a bad thing. 0.4% is a good thing. That is a slowdown from what we have seen in past months. If we look strictly at this month compared to this month last year, which is what this core and headline CPI actually looks at, not the month over month, we find that 0.5% decrease, which is well above what people are expecting it to be. Excluding excluding food and energy in this estimate, we find that this core inflation has dropped 0.3% from 6.6% to 6.3%. That, again, might not seem like a lot. We're still talking inflation in the 6 to 7% range. It's progress. It's moving things in the right direction. And this is actually only the second month in the past 18 months that we've seen both a drop in headline and core CPI inflation. Question: does Jerome Powell give an F about the stock market? Great question. Does he care about investors' money when he says or makes changes? Yes. The stock market is part of the US economy. It is the way that most people interact with, beyond buying products, it's the way that most people interact with companies that make up our economy. What he does not care about is the short-term impacts. And it's not his job to. What his job is maintaining the long-term health of the US economy. He and the Fed as a whole tries to be very reactionary. They try and react to things happening to try and shift things. Their biggest risk is taking things too far. So they will always make small changes until they start to see progress happen. And they are still doing that. Again, 0.75% is large, and we're working our way up from 0%. But the percentages that we're looking at for the federal funds rate are still pretty low compared to what they've been in history. Let me see if I can find... Aha. A couple of months ago, I did this webinar, so it's not going to be up to date. But the federal funds rate has been quite a bit hotter than what we're seeing right now. If we bring this over to a new chart, there were points back in the 1980s that we saw the federal funds rate sit at 20%. It is not uncommon for us to see federal funds rates in the 3 to 5% range. It is notable right now because we are increasing it 0.5% intervals, which is extremely large. Like, again, that is much larger than changes we've seen in the past 20 years. It is not unprecedented, and it's not immediate cause for concern. The last time we saw an increase of 0.75% was 1994. So this is not something unprecedented that we are seeing these numbers. Can I share that sheet? It is wildly out of date, but sure. Because I did this webinar a couple months ago. I did this back in May. So it will only have data up through May, but yeah. What I'm really trying to get at here is, does Jerome Powell give a damn about the market? Yes, he does. But he is more worried about the long-term health of the economy. The numbers that we're seeing for the federal funds rate right now are not unprecedented. They are quite normal. What is a little bit more surprising is the aggressiveness of those changes. The 0.75% increases are very large, but that's not a bad thing. If that's what it takes to get inflation back under control, I think that the benefits of lowering inflation are much more substantial than the short-term losses that the US stock market might see. Bear markets always end, bull markets always succeed, and bull markets always rise above their previous bear market lows. The US economy is something that we need to kind of protect. That is their goal. Their goal is not to maximize profits in the stock market. Their goal is to maintain the long-term health of the US economy. That's why they don't use PCI inflation. CPI inflation. They use PCE inflation. It is a metric that is slightly less volatile and a little bit more long-term looking. Their goal is long-term health, not short-term profit. Great question. Awesome question. So, getting back to CPI inflation here, the core and headline CPI inflation numbers went down in October. So the release that we got this month, yesterday, showed decreases in these two numbers, which is the first time since March that we have seen that, and the second time in the past 18 months that we have seen a decrease in both of those. That is substantial, and the market responded very positively. Before market open, SPY surged 4%, closing up 5.5% on the day, which makes it the single largest percent increase for the S&P 500 in the past 2 years. And if we ignore 2020, because March of 2020 saw some of the largest changes in the past 50 years. If we exclude 2020, 5.5% is the largest single day increase for the S&P 500 since 2009. I don't think you need me to tell you that that's a very important milestone. And that is actually very good news. Good news is good. That's excellent news. If we look instead of 1 day performance at 1 week performance, what we end up finding is that every single sector has shown positive returns, with communications and technology recovering the most. Again, they were the hardest hit. They are more sensitive sectors. They will be the most affected by negative changes in the market, but also the first to reap the rewards of positive changes. And they did. Communications saw a 1 week change of 8.2%. Technology saw a change of 9.9%. Now, if we look towards the matrix and look at matrix data, what we end up finding is that every single ETF is currently in a column of X's, meaning their current price direction is upward, and the majority of them are on buy signals, being those breakout signals. So that's good news. That's really good news. But we're 1 day after that news. And this is part of the reason why I wanted to do this webinar today. So here's the big question. Are these gains here to stay? Romulo, last week I hear lots of talks about circular and cyclical economics. Yeah. I've done a couple of webinars in the past on cyclicality versus seasonality. I think that's literally the title for it. If you go to the Learn site, I'm sure that it's somewhere under that. Kira's going to look for it. But yeah, market and economic cycles are very well established and understood things. We are not the first ones to discover that. That's why sector rotation trading works. Now, big question, are these gains here to stay? The answer is my opinion, not fact. My opinion, are the gains here to stay? Probably, but we're going to see some pullback in the short term. It is very likely that the market right now is overly enthusiastic and is going to buy too much and push a little bit past where they really should. Earnings were not dire. They were not horrible, but they were also not outstanding. It redefined a lot of that future value for many companies. And right now, I still think that for some companies, especially those ones that were the hardest hit from earnings, they were also the biggest ones to take advantage of this good news. And I think for some of them, it might have gotten pushed a little too far. I would not be surprised if next week opened with some minor losses as things get back a little bit closer towards fair value. But that said, that's very short term. That's in the next days. As far as the next weeks and months, October has a history of being a bear killer. Not because of some superstition or some different market event. Quite literally, October has a reputation as a bear killer because it's the beginning of bullish trends for a number of different industries. Those industries include semiconductors, discretionary, travel, a number of different and diverse industries. We are now not in November, or we're not in October anymore. We're now into November. But these trends continue well through the beginning of next year. Seasonally, they continue well through December and into January, at least. So that's a lot of time for historical seasonal trends to do their thing. So I very much still feel that while we might see some pullback, we are seeing recovery. Economic data is looking better. Hopefully the Fed doesn't have to continue being aggressive with federal funds rate changes, and that CPI data continues to show improvements. Those changes that we saw yesterday were very, very positive indicators. But as I said before, we saw this before in March, and things didn't get better. 1 month is a data point. 2 months is a trend. 3 months is a pattern. I don't know if that's actually how it ends up working, but that's how it works in my brain. 1 month could be random. 2 months, now we're getting somewhere. 3 months, there might be something here. We are in month 1. I guess you could even say September with the 0.1% loss for headline is better, but core CPI did also go up. This was the first month that we've seen both go down since March. I'm hopeful that that trend continues. I do think that trend will continue. There's nothing to say that it won't. And I'm hoping that this is the end of the bear market, that we have seen market bottom and that we do see continued recovery as companies continue to generate profits and hopefully consumers' spending power as inflation goes down returns to what it was before. Consumer spending is still high, is still growing, and is indicative that all of this will pass and that what we're looking at right now is positive long-term changes to the overall economic environment. Elizabeth, is it likely it will go down when they raise the interest rate again? I don't think the market will ever respond positively to a federal funds rate increase to the extent where we're seeing them right now. We want the Fed to stop, but the Fed's not going to stop until there's a reason for them to. I think that the market is going to weigh much more heavily on the CPI inflation data and consumer spending data and things that relate a little bit more towards buying and spending of money That's, after all, where a lot of these problems emerge, is consumers feel pressured because of how much things cost. So they're spending a little bit less on the things they want to buy and spending more money on the things they need to buy, all of that. But again, my opinion is that we saw market bottom back in October. Earnings were the first step towards progress, and this inflation data is really the catapult that we needed to get a bullish trend started. Long-term bullish trend started. But that's my opinion, and that's where we are today, November 11th. What comes next is, again, we're not out of this just yet, and we're far from being in a stable economic climate. The current direction of inflation is a welcome change. Seeing inflation going down is a very positive thing, but in order for any of this to stick, we need to see those economic metrics continue to go back down. Company profits are very strong, but things that we need to spend money on, like food, milk, eggs, utilities, gas bills, electricity bills, water bills, and transportation costs, remain very high, with over 10% changes year over year. So before we can really say we're in the clear, atmosphere has improved for investors, but we need to see atmosphere for businesses, investors, and consumers alike improve before we can really say we're in the clear. But again, that's my opinion. If you have different thoughts or you have your own ideas that you want to contribute to the conversation, please feel free to put them down in the comments. It's always great to hear from you all and have a conversation about all of this data that we get to share. Again, if you're interested for any of the sources of the data that I talked about today, they will all be in the resources section down below. Thank you all so much for joining us. Thank you so much for all the birthday wishes, everyone. I appreciate it. And we'll see you all back next week. Thank you all so much. Take care.